right. It is Wednesday night. We are 6 minutes behind. It is 9:06. So, with that being said, I want to welcome everybody to Invest in Education Academy. If you're watching the live or if you're listening to the podcast, we are glad you're with us. We have a very good topic for you all today. It's called stay-at-home stocks. Now, some of you all are probably making a face when I say stay-at-home stocks. I'm going to let Leon explain what is meant by that term and why we chose it.
Yeah, so a lot of people, so the reason I chose this topic was because everyone is focused, Brent said, everyone's focused on stay-at-home stocks. And stay-at-home stocks, that term is it's like a new hot buzz term now. But stay-at-home stocks are the ones that we all know and love. Primarily, big one is Zoom. A lot of us are using that for work now. Brent and I are on that right now. Facebook, a lot of people are on that hugely now during the day because that's how we're kind of staying in touch with people, family and friends. And then Amazon is another big one because that's how a lot of us are actually shopping for food and clothes and things of that nature. So those are three examples of the big stay-at-home stocks. There are a ton more. There are a lot of cybersecurity stocks that we covered in the past because a lot of these our home networks now have to be secured because we're all staying at home now. But those are the big three that all of us know. So Zoom, a lot of us are using that for work. Facebook, a lot of us are using that for just communication and recreation while we're at home. And then Amazon, a lot of us are shopping. But that term stay-at-home stocks, I don't think a lot of people are paying attention to one of the key words in that statement, which is home, right? So, I mean, all of us, 99% of the time we're spending a lot of our time outside of our home at work, commuting back and forth to and from work. Whereas now a lot of people are just at home all day, every day, either working or, sadly, they've been laid off in our home for, reasons outside their control. So a lot of us are home, right? Another thing is that so what I want to focus on is that home portion, and what a lot of people don't seem to realize right now, and I get why it's not really obvious, is that home buying in the United States right now is booming. I mean, it's off the charts. If you talk to any realtor, they're going to tell you, look, they can't, any home that goes in the market is off the market within, maybe a few weeks to a month. I mean, home buying right now is completely off the charts, and it's kind of counterintuitive because you would think like, okay, with millions of people out of work, with us in a recession, how in the world are people, how are people buying homes? Brent, if you could throw up slide one when you get a sec.
And also, while I'm pulling this up, and for many of you all who don't know the stats or don't know, really what it looks like, the home buying piece, we actually had Russ Brown on about 3 days ago, Sunday night. And it was a great interview. If you haven't watched it, I would suggest scrolling down after we're done, checking out that, because he gave stats on what's happening in the real estate market, specifically in the DMV, but you can see how it's applicable on a much more like a national level. So again, if you haven't had a chance to check that out, I would suggest that you spend some time and just take a look at it, because it's kind of amazing when you see the numbers. Let me pull that slide up.
Yeah, Rush dropped a lot of jewels. And that's kind of what got me. I mean, I had known about the kind of what's going on in real estate, but after hearing the interview we did with Russ, it really made me want to dig a little deeper into what's going on. So Brent pulled up our first slide here. And as I said, it's the title of this slide is stay-at-home stocks, keyword home, right? So as I said, the three big ones, the stay-at-home stocks are Zoom, Facebook, and Amazon. Again, we're using Zoom for work, Facebook for some sort of recreation, and Amazon to shop and live for lack of a better term. But so then below that now, you see I have this type of economic carnage, right? So all of us know right now we're in this COVID environment, which is terrible. Right now, the stats here are showing that 30 to 35 million people right now are collecting unemployment. In February, that was just 6%. Sorry, that was just 6 million people. So we've had a 483% increase in the number of unemployed in this country. We went from 6 million up to 30 to 35 million people that are unemployed, right? So, of course, the first thought is, well, with that many people unemployed, how in the world, do we have such robust home sales? The primary reason is, the primary reason is that I'm losing my train of thought. Dude, I totally lost my train of thought. The primary reason is
a big reason why you're kind of pulling that back in.
Yeah.
Is the fact that a lot of people exiting cities. So there's no
Yes. Thank you.
And the exodus has been occurring because they don't want to be in these closed environments. You want to take it from here?
Yeah, good. Yeah. So, okay, yeah, the primary reasons are one, it's good. We actually have this on the next slide, but I'm gonna kind of bring it forward first. Is one, we have historically low mortgage rates, right? So rates are at historic lows. Like the Federal Reserve cut interest rates to effectively zero a few months ago, right? So I mean, it's really between like 0 and 0.25% are interest rates, right? So they're at historic lows. Another reason, as Brent said, is there's right now, a lot of people don't know this, but there's a big exodus going on from cities into suburbs and rural areas. And that's because we all know because of COVID. Like people are really scared to be close to people and living right next door to people or even go out and socialize with people. And the third reason is low supply of homes, right? They're just before COVID, there was a huge the market was actually hot then too. The real estate market was hot then too. So there was a low supply then. COVID hit, and now you have all these people that are in cities that are now saying, okay, because remember this work from home thing is big too, because now employees that used to work in their office downtown can now work from home. So they don't actually need to live in New York City, Washington D.C., Dallas, Texas, Los Angeles, California. These places where home prices are massive, right? They're really expensive. So now people can actually say, okay, boom, I can work from home, and then I can now move to a place where the home prices are a lot cheaper. So so all that demand of home buying is really pushing up the stocks of home builders, right? So again, this is something a lot of people aren't thinking about. Everyone's thinking about those work from home stocks, which are more technology stocks. But if you look at home builders and things that surround home builders like Home Depot, Lowe's, to some extent Walmart, retailers that sell things that people need in their homes, booming like crazy. So next point on this chart is I have here saying the home builders are shining. So below that, here's some stats on what's actually happening with homes. So in July, home building construction was up 22.6% from the previous month and 23.4% from the previous year, as stated by the Census Bureau. So that's huge. So that shows that month over month, construction is up huge, and then year over year, construction is up huge. So again, these home builders are building these because they have the demand. There's a lot of demand for homes right now. And the next point is actually bigger. So construction on buildings with 5 or more units increased 56.7%. So that's apartments and multi-dwelling homes. And again, you have a lot of people leaving these cities that are moving out to the suburbs or out to rural areas because again, they want to get away from this whole COVID being close by. I actually have a friend of mine that lived in New York City, and actually as COVID hit, he took his family and broke out for Connecticut. So he was like one of the early people that I had seen do this. Actually before things really hit, but it's really grown over the last 4 to 5 months where people are actively leaving cities and moving out to the suburbs. And those a lot of those layoffs that you see, the 35 million people, a lot of those are actually are service workers, like restaurants, a lot of people in the hotel industries, things like that, vacations, airlines. Those are a lot of those workers, right? So those are a lot of times considered like blue collar workers. But white collar work, like in executives, people that work in 9 to 5s in office buildings, things like that, they're fine, right? So they're just working from home, earning their same salaries. There's been no pay cuts, and actually they're getting the stimulus checks too, from the government. So there's a lot of money. So it's counterintuitive thinking that okay, you have 35 million people unemployed. So how is all this buying happen? Well, the flip side of that, there are actually a lot of white collar workers that are still employed that are actually getting more money from the government in the form of stimulus. That are looking to move away from these big cities. Yeah. So that's really driving up demand for homes.
And also, when we're thinking about, we talked about it on the last interview we had with Russ on Sunday. Again, I definitely suggest you listen to that interview with Russ Brown, realtor and real estate investor. But one of the things we talked about was the shift in the supply demand curve. So as he was saying, builders are building, but they're not building as fast as the demand for housing. So a lot of these sellers, they're commanding premium amounts for their houses. So some cases are bidding wars. There are individuals who are definitely willing to go over the asking price, which are causing, it's like a ripple effect. Now other homeowners, their friends, their family members, the stories start, right? I mean, it's similar to the stock market where that popularity kicks in. If enough momentum gets behind it, people don't even know why the stock is shooting up. They just know they need to be in it. And so sometimes you get those people like, oh, I put my house on the market, sold in 2 weeks. And everybody who was kind of on the fence they're thinking, okay, if I could sell my house too in that short period of time, interest rates are at a historic low. I probably can get a 15-year for the amount I'm paying for this 30-year. Now's my time. And then on top of that, they just got some stimulus money, and they were able to suspend their bills because a number of the credit card companies, mortgage companies, and they're letting people suspend their mortgage payments until this gets, figures out what the new normal is. And so all these factors are hitting at one time. And that actually means some households are seeing a temporary economic gain. And you really have to think about that in addition to, the urban sprawl kind of going in reverse, where it's an exodus of some of these inner cities into the more suburban areas where there's room. Okay, if my kids can't go to a playground, I want a backyard. Just simple things that make sense. And, then on top of that, the numbers are tracking it too. The loans, suspension of other bills that they're paying, the ability to get more money on their house than they ever had in the last few years. So it's a lot of things that are kind of leading to this. It's not just a fad. It's actually backed by numbers.
Right. And what's going to happen is it's definitely not a fad, because buying a home, and you can go to slide 2. Buying a home is not a trivial thing, right? So, people now that are buying homes, it's not like they're going to reverse their home buying, when COVID's over. Like this exodus to these rural areas and into the suburbs is going to have a lasting effect. These people are going to, people buy homes for, decades, if not longer. So this is actually a huge shift economically that's going on. Now, so here on slide 2, I kind of went through some of these before, kind of things that are causing it. Again, I'll just go over it again. Historically low mortgage rates, an exodus from cities to rural areas via COVID, and then low supply, right? And so, okay, having said all that, now of course it's, we're an investment podcast, so let's get down to the money. So I pulled 2 examples here. So the first one is LGI Homes. They're a home builder, and so is DR Horton. They're also a home builder. Now, and these are 2 home builder examples, but there's also an ecosystem around home building. So things like Home Depot, Lowe's, Sherman-Williams, I know is a public company. They sell paint. So you find that, it's not just home builders, but the ecosystem around home building. But I just chose 2 home builders because it's kind of the foundation of everything. So as you see here, LGI Homes, and so what I'm showing here is from the COVID low, from March. And when I say COVID low, I mean when the market tanked in April and February and March, it hit a bottom in March. So since then, LGI Homes, since that March low, is up 250%, and DR Horton since the March low is up 200%, right? And you wouldn't think, at least I wouldn't have thought, that a home builder, an old line legacy home builder could make such a drastic move. But again, in the environment that we're in right now, the huge, massive demand they're seeing, investors are running towards their stocks. And in contrast that with one of the stay-at-home stocks, which is Amazon, since that same low in March, Amazon's only up 54%. The market as a whole, as of I think today, is up about 50%. So that shows you how these home builders are greatly, since March, are greatly outperforming the market as a whole. Now, Brent, you can go to the next one, slide 3. So now the question, my next thought was, okay, that's good to show, kind of short-term gain, but then what's the long-term gain, right? So since March, yes, we saw 200% gain and 250% gain, which is great. But now this is a 3-year. So what we have on the screen now is a percent returns graph that's showing the bottom we have the S&P Home Builders Index, ticker symbol XHB. Then we have DR Horton, ticker symbol DHI, and then LG Homes, ticker symbol LGIH. So what this is showing is that the sector, so the S&P Home Builders Index, which tracks, again, the sector as a whole, tracks, I can't remember how many stocks. It's quite, I think it's maybe around 50 stocks that it tracks. It tracks industry. So the sector is up 40%, right? Now, DR Horton above that is up 112%. And then LG Homes is up 155% over 3 years. So what this is showing you is that, you can't really look at this and say, okay, well, it's just because of COVID that these stocks are moving up because of, the high demand, everyone exiting cities. That's in the short term. But what this is showing is that in the long term, these home builders actually have been outperforming their sector by far, and actually outperforming the general market by far as well, because the S&P 500 home builder index is up about, like I said, about 40%. The general market, the S&P 500 is up about 50%. So it's only up about 10% more than the home builder sector. Whereas again, the individual stocks, D.R. Horton is up 112% and LG Homes is up 155%. So that shows you the power of home builders. And again, when you say stay-at-home stocks, don't just think the Zooms, the Amazons, the Facebooks. Also think about that home portion of that phrase, and home builders, and then the services around that, or the other entities around that, like Home Depot, Lowe's, Walmart to some extent, Sherman-Williams, like I said, is another one. They sell paint, things like that. So we go to the next slide, Brent. So the key takeaways from today is basically that. So the first point is just basically saying how the stay-at-home stocks are really driven by this exodus out of the cities, because again, COVID has people scared to be even standing next to anybody. The second point is that low interest rates are people can buy as much home as they want right now. I mean, figuratively speaking, but they can buy way more home now than they could have even in March or even last year. So that's driving people to get those really low rates. And third point is that again, when you think of stay-at-home stocks, you're probably thinking more technology, but also thinking about the home portion of that phrase, because as we showed, these home stocks, these home builders are really they're crushing their sector as far as returns, and they're crushing the market as a whole as far as returns. And as I said, Amazon since the March low is only at 54%. LG Homes is up 250, and D.R. Horton is up 200%. So I just want to kind of bring this to people's attention that the stay-at-home moniker isn't just for technology stocks that we all use for work and entertainment. Also think of the foundation of that phrase, stay at home, the home portion of it is huge too, as we just demonstrated.
Yeah, one of the things you said was foundation, right? And if you're thinking about foundation, earlier, actually back when Katrina had hit years ago, I started buying concrete companies. And it was really thinking about most of the houses there foundationally had damage, and concrete was going to be needed for every house, even if it just makes cinder blocks. And so when you're thinking about just the stay-at-home marketplace, kind of go through the deconstruction of it in your head. If you're an IEA member and you want to discuss what the other options are when you do deconstruct that environment, we can definitely talk about it in the platform. There's actually a group there for extended Facebook Live discussion. So post something there if you want to unravel this a little bit more, and we'll do so. And before we wrap up, and we're about to give you the stock picks. So 2 stock picks coming your way. I wanted to let you all know tonight at midnight, we will have some membership price increases going on. And if you haven't, or if you've been thinking about, or if you want to let family and friends know about IEA membership, now's the time. Again, tonight at midnight, the prices will change for some of the membership platforms. And anybody who's in now, nothing changes for you. Your price is locked in for as long as you choose to be an IEA member, in which case we found out our retention rate is over 90%. And that's hopefully because we have a really great community and we're providing you all with amazing content. Some people who have joined the IEA membership have actually been shocked at how much information there actually is inside the platform for all membership levels. So if anybody's interested and you've been kind of on the fence about it, now is the time. Today is the time. Right now is your moment. So you can go to www.ieamembers.com. The URL is actually on the bottom of the slide. So please join. We look forward to seeing you. Although I will say, even once the prices increase, it's still a great value to join the membership platform. But if you have the opportunity to get in a far lower price, you should do it.
Agreed.
So do you want to lead off with the pick today, or shall I?
Yeah, I'll go. So my pick is a company called PTC. Ticker symbol is PTC. Same as the company. They closed at $88.54. Today they were down 1.46%.
What's the ticker symbol?
P as in Paul, T, Tim, C as in cat.
Okay.
So what they do is they're a tech company, and they're involved in Internet of Things and CAD software and design services. So Internet of Things just covers
everything.
everything, right? Internet of Things is a catch-all for like any internet connected device. So so they provide services around specific different kind of connected devices, but they really started out as a CAD provider, computer aided design, and they've kind of branched out to the Internet of Things now. So the stats on them is that their profits are awesome. So the 2-year average profit percentage gain is 53%. That's 53%. And their average sales over the last 2 years is 7%. So they're growing profits hugely, like I said, 53% over the last 2 years, and sales growth of 7%. And again, it's PTC. Brent has it on the screen, and that's my pick.
All right, so Leon, I'm gonna ask the question as if I were someone else. Now, I see with the 52-week range, it's between $43 and $90.30, and it's currently trading around that 90 threshold. Do you think it's still room for it to grow?
Oh, without question, yeah. So one thing about my picks is, again, Brent and I are different, as we always say. I will very rarely, if ever, pick a stock at its 52-week high. As Brent always says, he in a lot of his picks, he doesn't care. And because he's looking for the long term. Me, you will never say never, but typically I will not pick a stock at or above its 52-week high. I'm always looking for that bit of a discount. And I'm sure no one's done it, but if you notice, a lot of my picks, they're typically like 20 to 40% off their high. And I have a whole methodology behind that on why I do that and the ways around that. But so for, as you said, Brent, this one is for me, it's actually closer to its high than normal.
Yeah, but I was like, what?
Yeah. No, I mean, when I picked it, I was even like, it was kind of pained me to pick it, but I love the company's financials. So for me, this is a little high for my usual picks, but I love the company. I love their financials and the service they provide. So I'm good with it. Okay,
and so for anybody who is listening to this, Leon is absolutely correct. It does, as long as it's a strong company, the 52-week high means really nothing to me. And the reason for it is, if you never reach a new 52-week high, then you're not growing. So at some point you have to bust through your 52-week high to have a new 52-week high a year later, 2 years later, 3 years later. So just mathematically, it doesn't make sense to really not buy a stock because it's under a 52-week high, unless you have a strategy to how you buy it. And I still say, most people, and I know Leon already has a strategy, so I'll say for anybody listening, be sure that when you listen to us, you understand that there's strategy behind some of the things we do. So Leon didn't say he wouldn't buy a company that's beyond his 52-week high because it's a bad buy. It's just not his strategy.
Right.
But these companies still, he buys them with the expectation that they will grow. It's not like he expects them for an infinite amount of time to stay between their 52-week low and their 52-week high.
Oh no, yeah, right. Yeah. The whole point of buying for me, below the 52-week high, is that I'm looking for that discount, right? I'm buying quality companies. So this is a kind of a 6,000-foot view. Is generally I'm looking for discounts on quality companies. So as Brent said, yeah, I wanted to bust through the 52-week high and go on forever, of course. But when I buy it, I'm looking to buy it at a discount. Does it always work? No. Some things you buy, they may never hit the 52-week high again. They may go down. But I feel like it gives me the better return on investment if I'm getting a discount relative to a 52-week high. So no, it has nothing. Again, a 52-week high, I'm not scared of it. I wanted to bust through that. And as Brent said, you can't have a winning stock unless it gets above that. So the goal is definitely for it to get above that.
All right, and that is a perfect transition into my company. So I'm actually picking a variation of a stay-at-home company, Shopify. So we haven't picked Shopify yet, have we?
No, but that's not what you. Okay, yeah. I didn't stop me.
Okay, so Shopify is actually down now. Points. It's just 2% off of its number, but I love the fact that with this stay-at-home shift, it's not going away. Like many of the people who had resistance, it's called consumer behavioral change. And it's a lot of people who oftentimes are resistant to consumer behavioral changes. And that is what e-commerce retailers were experiencing post COVID. I mean, pre-COVID. So now within COVID, because there is no post-COVID yet, nor do we know what that will look like. Now, many people who had that consumer behavioral resistance are willing and getting used to every day buying online. And it's becoming more accepted and just a way of life. Shopify is actually a company that is designed to absorb a lot of smaller companies to grow its platform. In addition to that, a lot of the independents is Shopify to me is between Amazon and Etsy. And it's like that little sweet spot in between where it's like, okay, it's an established company. It's not the size of a Mercado Libre or Amazon, but it's bigger than an Etsy. It's been producing, and right now, the reason I said it was a great transition, it's trading $9.11 right now. And that is right below or in the range of its 52-week high of roughly $1,107. So it's well positioned. I know they've been growing. I know a lot of the print on demand companies or print demand entrepreneurs have been flocking to Shopify. And I really appreciate the way they've been able to scale their business and actually pivot during this time period to dive head on into the print on demand platform for everybody who's all of a sudden become a designer or, they're the new clothing gurus of their clique. So Shopify, and the ticker symbol is SHOP. So that's
one thing I say also about Shopify is either they're implementing it now or they did implement it. So there's something called fulfillment by Amazon. It's called FBA, typically Amazon FBA. And what that is where retailers, they send so what happens with a lot of people on Amazon, a lot of sellers on Amazon, they actually buy their products from China. A lot of them buy it through Alibaba. Mm-hmm. And, so when you're buying something overseas, you have to ship it over here and then house it and then have it shipped out. Well, Amazon started this thing called fulfillment by Amazon, where they actually warehouse sellers' products and ship it for them. So now retailers on Amazon, mom and pops, don't have to worry about storing all their goods like in their garage or going and trying to rent out storage space themselves to store these goods for sale. Amazon takes care of all that for them. So recently, and I can't remember, I don't know if they're doing it now, they're about to implement it, but Shopify is either doing or is going to do the same thing, where they're then going to house and then ship products for their sellers. And that was, huge. A lot of sellers. I know a lot of, well, I don't know personally, but I've seen a lot of stories where a lot of sellers on Amazon are really tired of Amazon, just because it's an 800-pound gorilla. They know it. They feel like Amazon actually is trying to compete with them. So a lot of sellers actually moving to Shopify. And once they offered that kind of that fulfillment by Amazon sort of copycat product, for lack of a better term, sellers were ecstatic. Now they can have their goods stored and then shipped by Shopify. So Shopify, people say it's the next Amazon, who knows if it is or isn't, but it's definitely in this environment is a strong pick. I remember when Shopify a couple of months ago was at like at $300, and now it's up, 3 times that. So yeah, I think it's a strong pick.
Yeah, and I think you picked Walmart, right?
Yeah, I picked Walmart a few weeks ago.
So Walmart also has like a kind of fulfillment platform, and they're growing their online sales like ridiculously. Walmart is not selling other people's stuff, but Walmart has started to shift its focus to the online retail space, and they're doing a great job. So I think it's not the fulfilled by, it's the Prime equivalent I think they have.
Yeah, it's called, so anybody who's a member of our Facebook group, if you want to find it, it's Investing Education Academy on Facebook. Just search that. So I posted in there today or yesterday how Walmart had a huge quarter, blowout quarter. They beat their numbers hugely. But the biggest thing coming out of their earnings call, or their earnings report, was that they grew their e-commerce sales by 97%. And the reason that's shocking is Amazon is the biggest retailer on the planet. And for it to grow anything at that rate, at that size, is unbelievable. That just shows the massive demand right now for e-commerce. So yeah, I picked Amazon a few weeks ago, and it was up.
You mean Walmart?
Sorry, I picked Walmart a few weeks ago, and it's been up. I think it's like 2 or 3 weeks ago. And it's up like 10 or 12% since then. But yeah, oh, real quick, on your point, Brent. The thing that Brent's talking about is called Walmart Plus,
Yep.
and it's the exact competitor to Amazon Prime.
Now, when you all talk about, you're probably listening thinking, okay, you guys always give these stock picks, but what does it mean? So just taking Leon's Walmart example, in our joint portfolio, I think we're at like 16%, 15%. But when you take a stock like Walmart and it's up 10%, that's the equivalent to you having your money in a bank for between 8 and 12 years.
Right.
So if you're trying to figure out like, what does that really mean? That means if you're in a savings account, you're losing. If your money is in a savings account and it's not in these investments, now granted, there's always a chance that this will go down. And we're not saying our stock picks are, you have to buy them. No one has to buy them. This is not a suggestion to any one person. This is our view on what could make sense in your portfolio, assuming a number of factors. But just think about this. If you were to have gotten Walmart when Leon suggested it, we're talking about a 10% move. That is the same equivalent to you having had your money in a bank savings account for between 8 and 13 years. Think about that. We're talking, when you picked it over less than what, 2 months ago?
No, I think it was, I want to say it was, if I remember correctly, it was July 8th. So basically a month ago.
Yeah. And so we're going to say it like we always say it. Whether you get a W-2 or not, you are an employer. Your employees are your dollars. If you are not putting your dollars to work for you, you are making a terrible mistake. Be it real estate, our 3 pillars are real estate, entrepreneurship, and the stock market. And really, if we're going to put it into order, we would say the stock market, probably what, Leon, would you say is next?
I mean,
that's a tough one. I'm biased, so I'm gonna say entrepreneurship.
I was gonna say, I would probably say real estate, just because it's easier to do. Like it's easier to buy a home than to start a business.
It is, but the bottom line is, if your money is not working, you are a bad employer. And why am I saying that? And why would somebody say that when they're trying to attract people to their platform? Because if it requires something to hurt in order to move you to understanding that your money needs to work for you, that's what we're willing to do. And it's not our money's better than your money, is their money's better than their money. None of that. It's that we have to change what is happening in our culture. Right now, Black America is just catching up to white America as it was in 1962. And you all are probably going to hear Leon and I say that through the rest of this year, because it has to stop. It has to change. Again, it's not, it's your fault. We already know historically we were at disadvantages from the beginning. But now with, events like the stock market and the way we trade now, you don't have to go to Wall Street, submit a ticket, and they won't let you in because you're Black. You can't, nobody wants to touch your ticket. There's no ticketing system. You go online, you push a button, nobody cares who you are. Nobody's checking for you. You can level the playing field, but will you do it? And if we wait to be nice about it, some people will never move. And even with our platform, if anybody's an IAA member and they've been through our platform, they know the information in there is beyond what you pay for. And Leon and I know that. Mm-hmm. And the reason why we push for it is a business, and the investment game is making us entrepreneurs. But the reality is we don't want to just win without everybody else getting a win. Because our members who have actually invested with us, if you've seen any of the hot seats, they're doing quite well. And they may have paid us, they may have paid their membership, but if you look at their portfolios, it far exceeds what they paid us, like by legions. And I mean, we've had clients in the last few months make $44,000. And we've had individuals who have invested with us years for like the last 5 years and known Leon and I, they've made over 400% on one stock alone. And so we're just saying this to you all, we don't care if it's us or another investment that you go into. Just understand, especially for the W-2 employees who feel like sometimes they don't have the power that they actually do have. You are an employee. You're an employee of every single dollar that comes into your bank account, to your pocket, to your shoebox, wherever it's going. What you do with it determines whether you're a good employer or a bad employer. I hope you're a good employer and put your money to work for you. So,
and like Brent was saying, kind of on that point, is that I mean, that was a good point you made, Brent, about the, so like I always say, the stock market is the great equalizer, because as Brent was saying, it doesn't know race, color, creed, religion. It just knows you click a button and buy a stock, right? So that's one point that so like with real estate, of course, we all know, well, if you don't, something called redlining is where banks basically excluded Black neighborhoods and minority neighborhoods from getting loans, or if they did give them loans, they gave them higher rates just because of the race. So the stock market, there's none of that, because it's, it doesn't know, it just knows the color of your money, which is green. Another point for the stock market also is that, so like Brent was saying, that interview we did with Russ, the real estate agent, on Sunday night, which is now on our YouTube and on our membership platform, he made so there's always this argument between, should you do real estate or should you do stocks? And I was telling him how on average over the last 150 years or whatever, the stock market has returned 10% per year. And he was saying, I asked him, what is it in real estate? And he was saying it's anywhere between 5 and 8%. Right. So what that means is that the stock market actually is, and that was Russ's data. I haven't vetted it. I haven't gone to look it up, but I believe what he said, because he's very successful in the game. But between 5 and 8% per year in real estate versus 10%. Now I will say that 10% is only stock appreciation. Once you add in dividends, the stock market actually returns 12%. Right. So on average, the stock market will return double, including dividends, double what real estate does on average. So it just goes back to the point that, there's to not be in the stock market, again, whether it's with your friends, with an investment group you have, whatever, to not be in this market, it just makes no sense. And it's like Brent said, you click a button, just click a button on your phone and then hold that for the next 10, 20, 30 years. And it's just a no-brainer. So I just want to make that distinction between real estate and the stock market, where on average the stock market does return more, and in some cases double what real estate does per year.
And let's run it this way, right? So let's just go to April of 2019, and we're gonna go for a little bit. Let's kind of unwrap this a little bit, Leon. And also, I think we should go a little bit longer and talk about the Apple split, just for those who just checked in, because it's happening in 2 days.
Okay.
Let me just make this one point and let's talk about the Apple split a little bit more. All right. So if you go back to April of, let's go back to, we can even accelerate it. What is it? We're in August, right?
Mm-hmm.
If you go to August 1st of 2019 and you had made the purchase of Shopify, we're talking about 12 months. In 12 months, that stock would have went from $385 to 1,009. Let's say that again. If you August the 1st, that stock was at $385. Let's just round up and say it was $400. That stock per share has appreciated $600. And sometimes people need to hear dollars.
Right.
So let's say dollars, right? That's $600. So if you had 10 shares, that's $3,085. 10 shares, $3,085 would now be worth $6,400. So your $3,085, if you would have just $850, if you were trying to buy a car and you had $3,850, you were like, you know what? Let me try to invest for a little bit and see if I can come back to this vehicle. And maybe the vehicle costs $7,000. If you would have put your money in Shopify, I'm not saying you did, hindsight's always easier in the rearview mirror than it is to look forward. So let's just say you had to buy the whole strategy. You put your money in $3,850. The car cost $7,000. You could have come back and almost paid entirely cash for that car instead of having a car note in the market. So basically, the market would have paid an additional $3,500 that car, $3,200. Where else does that happen?
Right.
Again, sometimes people need to have like an item and to really in the numbers to understand, because percentages can get lost. And that's just in 1 year. We don't even know where Shopify is going to be in the next, 3, 4, 5 years. But this e-commerce, as much as we like to think, since we've been in it for a while, we've seen it. Oh, we haven't even come close. We haven't even come close we're talking about, 5G coming, which I'm not a fan of, but the reality is it's coming. It's here already for some. But as phones are going to get smaller, faster, watches are going to get more advanced. I mean, at some point, we'll probably just be able to think about it and it'll be at our door when we get there. So e-commerce has a long way to go. And then the data that it's producing is just making it more efficient by the second. So just for any of you all who think like, oh, this market's a fluke, this stock market thing, it really doesn't work. Yeah, it does. But
so that Brent gave the numbers, the actual dollar terms. So that percentage gain is 150%. So in 1 year, you would have made 150% on your money in 12 months. Now, as we always say, Shopify, that example is an outlier. That does not always happen. As we said, the market in general returns 10% per year. But what we're saying is, like, unless you're in the game, unless you're in the market, you can't even get an opportunity to invest in things like Shopify.
Oh, Leon, give me 1 second. I have to touch on that.
Oh, yeah.
For anybody who is a sports fan, I see Beverly on here, Michelle, Vanetta, I know you all are listening, Karen, Magali, Lene, James, I see all of Bakari, I see all of you all, and Wayne, family members on and listening, everybody in the podcast. Let me say this. Any of you all have ever been to a sporting event, for any of you all, and I would love if you all can just put yes, me, or just yes, me in the comments. If you've ever been to a sporting event, what is the one thing that can happen for a fan or can't happen for a fan, no matter how many games they go to? But does anybody, I'm just pausing to see if anybody knows. If you're driving your car, do you know? What's the one thing that can never happen for a fan, no matter how many games they go to? I see, okay, I see comments coming in. You can never win the game because you're not actually in the game, you're watching. And for anybody that can name a fan, a super fan, a mega fan that has won a game, I would love to hear that story.
That's right.
As far as I'm aware, it's never happened in history that a fan. Now, Beverly said, I just jump in the game. That's true, because Beverly even, one of the things I'm kind of taking this to, I'm likening it to IEA, right? So for those of you all who watch these lives, we definitely appreciate you all. For those of you all who, are part of the Facebook group, the Investment Education Academy Facebook group, we appreciate you all. And we're saying it's not for us, but it's for you all. If you're watching and you're a fan of what we're doing, that's great. But if you're not going to get in the game, then there's no opportunity for you to win. Now, also, what happens to a fan who watches every game and goes to every game? There's never an opportunity for them to lose, right? Wrong. They lose their money all the time because they have to pay a ticket to get in and actually be a spectator.
Right.
And the equivalent is you're leaving your money in these inferior investments. Some of you all, not all, are leaving your money in these inferior investments, and you're watching these lives. You're like, this is cool information, or you're listening to the podcast, like, oh, that was cool. You turn it off and you go back to the exact same thing you were doing before. You're the spectator paying your ticket, and then you're just leaving and going home. You didn't win the game. You didn't technically lose the game, but you lost your money.
Mm-hmm. And that's even worse. if they had the scenario, well, yes, they bought a ticket, they're not in the game, but then they have their money in a bank account sitting there, paying you less than inflation, which in turn means you're losing money every day on your money sitting in a savings account. It's even worse. So yeah, you're not in the game. You can't win because you're not part of the team. You actually lost money because you paid for a ticket, you paid for parking, you paid for concessions, you paid for beer, you paid for all that. Then you went home, went to bed, and went to work the next day, and then deposited your check into the savings account that's paying you 0.002% when inflation is 2 to 3%, right? So that's what we're saying. It's like we gotta get our money out of these, as Brent said, inferior investments, because we all like we always say, we always know about the wealth gap, but as Brent and I have identified something we call the ROI gap, which is where our money, meaning the Black and brown community, our money largely sits in savings accounts and in debt, things like credit card, personal loans, car loans, that earn us essentially nothing. Whereas, again, the other half of white America, they have their money in the stock market, they have their money in a business, they have their money in real estate. So what we found out is that on average, white America earns 139% more on their money than Black America does. So the wealth gap is something that we can't really control directly because we can't control what employers pay us. But what we can control is the money that we receive from our employer and how we invest it. And as Brent said, we then can employ our money to work for us. So the wealth gap is something we can actually control, because we can narrow that wealth gap, because we can get higher returns on our money. The wealth, the ROI gap. Take it back.
Yes,
the ROI gap. Yeah. Sorry. We can control the ROI gap, because we can control how much we earn on our money. The wealth gap's a little harder, because that's like a societal thing. It deals with how much we get paid on the dollar versus white folks. That can deal with like real estate, loans and things. So wealth gap is a lot harder. The ROI gap is something that us at IEA are really focusing on, because we can actually control that. We can help people, put their money into higher paying investments.
And moreover than any of them, right now, we're trying to narrow the financial literacy gap. Every time we go live and we have these rants, is really because we're actively trying to narrow the financial literacy gap. But then there's also like a emotion that's tied to it, and just to kind of, it can never happen to me disposition. And it's something that we're working hard, which is why we do these, which is why we talk so long. It's not to hear ourselves talk. It's not because we want to show that we're smart, because again, anybody that really knows us we're like this no matter where you meet us, how you meet us, what we're doing. This is us. But we do absolutely know sometimes you have to go on these rants, because it's the only way to show people that is very important. And even if we get one person from this who's like, you know what, all right, I'm gonna make today I do something different, and I really commit to narrowing the wealth gap for my family, then we won. And we've had those people this week and last week. Last 2 weeks we probably had like 10 people join, which is, we're doing well, but our goal is really to narrow that gap as much as possible by looking at financial literacy and ROI. Mm-hmm. Those are two gaps that we can actually do something about, and we are. And so when we go to that next place, the one thing Leon and I both will be able to say is we tried to make our community better. Really tried to make our community better. And there's a bunch of rip-off artists. There are people that really don't know crap about the market. They don't know how options work. They don't know how life insurance works. They don't know how mutual funds, ETFs, spiders, asset allocation models, contingent deferred sales chart. They don't know a lot. The 5-year moving average, 330, whatever. They don't get it. We do. And we're not spitting that, because that's not what's going to help you digest financial education. So
and today's topic was kind of an example of that, because like I said, a lot of people, some people may not even heard the term stay-at-home stocks. Maybe that's just I'm deep in the game. But I know people that have heard of that term. They often think again of the Zooms, of the Facebooks, and of the Amazons, because again, those are stocks they use so much while they're home. They're on Zoom for work, they shop at Amazon, and they use Facebook for kind of recreation. The point we want to make today is that, and what we want to do with IEA is, again, expose our community to, again, think outside the box. The term is stay at home. No one ever thinks about that home portion of stay at home. And as we showed today, that home builders have been a huge winner in the last 3 months. Again, the ones we showed today were up 250% and up 200%. In that same amount of time, Amazon is only at 54%, right? So that's another thing we're trying to do, because a big thing is that we can't narrow the wealth gap. Sorry, we can't narrow the ROI gap if we stay in the same investments that everybody else is in, right? So if everyone owns Amazon, right? Everyone. That's one of the most widely held stocks right now there is. I would imagine that LGI, I think it was LGI Homes and D.R. Horton are not the most widely held. They're not household names. And again, that's what we want to expose our community to, is that there are stocks out here that are making, as we said, 250% in 3 or 4 months. Yeah. Right. Brent said that would you have to make that. It would take like 30 years to make that much in the bank.
Oh, no, you can't. Like in the lifetime, if you go 100 years in banks as they are right now, you couldn't. It's impossible. You couldn't.
And so it would be longer than life expectancy.
It'd be longer than your life expectancy.
Right.
And even stuff like that. Like, who has ever told you if you compare certain investments in the stock market, you don't have the life expectancy in a bank to even remotely achieve that. People aren't telling you that. They don't even know that. They don't know the math. And so, we are trying to really drill this home, because, I've met so many good people who during this COVID experience, they're realizing how short their money is. And it's because their money wasn't working for them. The money was never working for them. They were working for their money forever. And being that term slave to your money, I hate that term, but there's some reality to it, because like I said, imagine you're an employer and every dollar is a potential worker. And every time you get a dollar, you just tell them to go lay on the beach and just sit there. Don't do anything. And we'll bring you drinks. We'll bring you this. That's inflation. That's all inflation.
Eating away at your money. Yep.
Eating away at your money. And it seems like it's just laying in the sand, right? No. If every drink that goes over, every new tanning oil that gets rubbed on them, because you allowed them just to sit on the beach and do nothing. And I'm going to paint that picture every time we talk almost, because I want you, when you have some money, to look at it when it hits that bank and just be disgusted. Like, oh my gosh, it's about to go lay down. It's about to take a nap. It's going on vacation. All those terms are the right terms to think, because when it hits that bank, it's not working for you. Now, again, you want to have your reserve money, and we talked about that. We gave what they should be. So we're not going to go there, and we're going to self-regulate, pull ourselves out, and we're going to talk about the Apple. Actually, Tesla's happened first, right?
Yeah, Tesla's is first.
So Tesla is doing a 5-for-1 split in 2 days. The 21st is going to be the date of record, I believe, and the 30th or the 31st is going to be the trade adjustment date. So the split adjusted date. I'm sorry, the split adjusted date. So Beverly said Apple happens on the 1st. Is that correct?
Yes. I'd rather 31st, but first 31st, it's right at the end of the month.
Did they push it out? Because I thought it was okay. Doesn't matter. So
yeah, but real quick, isn't Tesla's, when is Tesla's?
I think it's the 21st.
Yeah, so I think I believe Tesla's first and Apple's is later. Yeah.
Apple announced it first, but Tesla's actual split is happening first.
Right.
So
right.
Tesla's about to do a 5-for-1 stock split, and we're gonna give you the just baseline. All of it doesn't matter. So if it doesn't really matter the date of Apple's or the date of Tesla's in the next 2 weeks, let's just say that. Apple's going to do a 4-for-1 split. Tesla's going to do a 5-for-1 split. It means nothing financially is better at either company because they're splitting. It just simply means the shareholders got together and they said, how can we attract more people to buy the stock? Oh, let's do a stock split. That will get more investors in, which gives them more capital, which gives them a bigger operating budget, which increases their market cap, which increases their research and development dollars, which theoretically should help them make more money in the long run, but is no guarantee of that. So what simply happens is it's a multiplier. Whatever you divide it by, the number of shares that are going to be split by. So if it's at $100 and it's, doing a 5-for-1 split, you're talking about a $20 stock. So all 5 will be $20 each. Pretty much that simple.
And as we and a lot of people may know or may not know, there's something out here called fractional shares, right? And what that means is if the stock is $100, if you have an account at Cash App, Robinhood, or Stockpile, those are the 3 that we reviewed earlier. If you have an account with those, if a stock is $100, you can buy it for 20. You can buy a 25% of 1 share for $25, right? So that's a fractional share. What Apple's doing and what Amazon, what Tesla are doing, they're basically formalizing fractional shares. They're just dividing their shares up and then putting it out on the market at a cheaper price. There's not a discount. There's no hustle here. It's just they're formalizing fractional shares, taking their share price from whatever it is now, dividing it by, as Brent said, the multiplier, and you get a cheaper price. Tim Cook actually said the reason they're doing this is to help more investors buy the stock. It has nothing to do with the financials, it has nothing to do with the product, it has nothing to do with anything. It's a marketing ploy. There's nothing wrong. Well, let me not say ploy.
Yeah, don't say.
Yeah, ploy sounds negative. It's a marketing reason behind it, as Brent said, to then push up the price of the stock. I don't know if a lot of people know, but either today or yesterday, Apple passed a value of $2 trillion with a T, $2 trillion. So Apple is now worth roughly $2 trillion. And when this split happens and all these people run in and buy up the stock again, It's going to push it up, 2.5, maybe even $3 trillion. So, I mean, and Brent said there are a multitude of reasons why that benefits a company when the market cap gets to these high levels. But yeah, the stock split to us, to you and I, means absolutely nothing. You can buy it now for a fraction of the price or wait for the split, but it's the same thing.
All right, now let's talk about the reality of what's going to happen more than likely. More than likely, you got to think the Robinhood effect kicks in. And I'm sorry if that offends anybody who's in Robinhood, but it's true. We're going to do a discussion on what happens inside of the Robinhood framework later on. And you absolutely want to be there for that discussion. But anyway, so a lot of retail investors who, again, there's nothing that we don't mean to say anything about anybody in particular, but who aren't necessarily sophisticated investors. They think that all of a sudden the stock went on discount and they have to buy it. And they're literally people who won't buy it now. They can afford it because they want to wait for the stock split, which is mind-boggling to me. But I understand we weren't educated on it. We don't know that if you're going to get it, you should get it anyway. You shouldn't wait for it to be discounted. So let me tell you what happens in the reality of the market. Once it goes to that lower price, this divided by 5, whatever it may end up being, $285, $300, there's going to be this spike of individuals who are so excited that they can afford it now when they could have gotten fractional shares the whole time. But now they can officially afford it. They can officially afford the stock. They're going to go to it in droves. Apple knows it, Tesla knows it, and they're waiting for that to happen. Now, let me tell you what also is waiting. A bunch of sophisticated investors who dropped the regular price like 2 months or as soon as the split was announced, because they knew that these retail investors, and it's called, they refer to it sometimes as the Robinhood effect, like they're going to come in all of a sudden, buy the shares, driving this price up because the stock becomes more popular and the stock price goes up. And then the more sophisticated investors are going to do what's called profit taking. What does that mean to us? They're going to bail. So they're going to take some of their profits, and it's possible. I'm not saying it's going exactly how it's going to happen, but Leon and I predicted that when the announcement came, was it for Tesla or Apple, there was going to be 3 dips before it leveled out, and it was exactly 3 dips. Mm-hmm. But anyway, so if that happens, the stock price is going to have a lot of volatility in it because you're going to have people who are new to the stock going in. You're going to have some profit takers pulling money out, and it's going to be a period of just extreme volatility, and it's going to cause some people not to lose sleep. Don't worry about it. The long run of both of the stocks, and this is my opinion, this is not Leon's, it's mine. This is not opinion of IAs as a whole. I believe both of the stocks will continue to rise in the long run after this little period of volatility passes. So either way, it's a good buy. They're good buys. But if you were going to get it after the stock split and you can afford it now, personally, I would buy it now.
And sometimes we take for granted that we think everyone knows about fractional shares. A lot of people don't. A lot of people don't know how to. So a lot of people don't. And the reason is a lot of the major brokers don't offer it. E-Trade doesn't. TD Ameritrade doesn't. What's even left? Because all of them got bought out. It was like those are like the 2 big ones. Yeah. I also have an account at Interactive Brokers. They actually do. They're one of the only big ones that I know of that actually does fractional shares. Most fractional shares are bought through Robinhood because it's the big dog, and Cash App. Those are like the 2, and then Stockpile is kind of third. So if you didn't know what fractional shares were, that's what they are. You can buy, again, if a stock is $100, you can buy 25% of one share. If you only have $25, you can buy it. If you have $50, you can buy half of one share. It allows you to take that stock price and divide it up by however much you can afford. And that's all a stock split is. It just formalizes that process. There's like I said, there's no discount behind it.
And for those of you all who are thinking, why in the world would I buy something with $25? It takes a penny to start to add up to $1. And if you can start somewhere, this is the important part, what might escape some of you all. You're still going to get the same percentage move, even with your fractional share. Mm-hmm. So again, let me say, if it's a 20, 30% move, that's still 20, 30% that you will not get in the bank. And so if you had $25 in the bank or $25 in the stock, it's still a difference of a 0.05% interest rate or a 20% interest rate.
Right. It's a no-brainer. Yeah.
Like So, again, some of you all are just simply going to go, well, if it's $25, why would I do it? And does Interactive Broker charge a trading fee, Leon?
So yeah, so interactive brokers is they lean more towards so the only reason I have interactive brokers is because I trade on margin, and that'll be a discussion at another time. But they have the lowest interest rates, I think, in the industry. And margin is when you're borrowing money to trade. And like I said, we'll talk about that later. But but that's the reason I have it. If you want to just buy stock with them, I believe that I think they have, which I cannot stand, is I believe they have an inactivity fee. So if you don't buy or sell enough stock within like a month period or 2 month period to generate, well, actually they don't charge commission anymore. No, sorry, actually they do. So they have different plans. And if you're a big dog, which I'm not a big dog. I don't have this plan. I have the margin plan. But if you're a big dog, you can get one of their accounts where they have no commissions. If you're kind of, like Brent said, a retail investor like myself, or like some people out there, if you open an account with them, if you don't do a certain amount of trades within a certain amount of time, they're going to charge you a fee. So I do not recommend interactive brokers unless you have a large, really large account. But like I said, I only do it because their margin rate, which is basically borrowing money, the interest rate on that money is really, really cheap relative to the rest of the industry. So if you're looking for fractional shares, do Robinhood, do Cash App, or do Stockpile.
Yeah, so I do Cash App. It's just easier.
And I do Robinhood.
Yeah. So I mean, that's it for us. You guys have our stock picks. My stock pick is Shopify. It means it's great transitions right back to Shopify. It's trading at $1,009, so it's a great. Well, for some can drop the check, but if you're concerned about that price, you can get fractional shares. Leon and I know that some of these things that we talk about may be attractive to some. Really, for others, is not even an option. If that's the case, the fractional shares is always a way to go if you want to get into some of these picks, but you feel like the price might be too high.
Mm-hmm. Yep. Agreed.
All right, everybody, it's been great. We will see you all next time. Podcast listeners, thank you so much for listening, sticking with us. And we hope that, you really make this time to do something different. Take this time to do something different. And if you're interested in Investing Education Academy membership, tonight at midnight, in 2 hours, the price goes up. It still will be a great value after the price increase happens. But if you have the opportunity to do it now, it's www.iea-members.com. Choose the plan that makes the most sense for you. And for everybody who gets in before midnight, you are locked in for as long as you're a member. The price you came in at will not change. So it's very important to know. Have a great day, and thank you for being with us.
See you.